So, welcome to this video, Understanding Your Profit and Loss Statement. The goal here is that at the end of this video, you will have a clear understanding of how to look at a profit and loss statement for your business, read it, know what it's telling you, be able to use it to interpret the data and make decisions and understand exactly what it's telling you. It is not something that you get taught in school unless you went to business school. It's not something that most business owners understand well or have ever been taught or have ever had somebody sit down and really go through it with them top to bottom to make it clear. It is something that you sort of feel like you maybe sort of understand. It sort of makes sense more so than maybe the balance sheet or the statement of cash flows, but it's not something that we necessarily understand well if we've never put one together, never had business education around this. And so I want to kind of demystify it and really start from the beginning, make it easy to understand, make it approachable, and something that you feel confident in looking at, because it really is the key to being able to understand how your business is doing. And with just a little bit of understanding and education around what it's telling you, you can get much more value out of it. If you don't understand what it's telling you or don't understand how to read it or look at it or what questions to ask, then, it just becomes another thing that you get once a month, like a bank statement or, anything that you don't really look at. I want the profit and loss statement to be something that you get something useful out of. So this is my effort to explain what it means so you can use it as a tool instead of tossing it aside and not paying any attention to it. So the profit and loss statement is kind of the most fundamental of the financial statements that business owners look at. And if there's one of the three that they could get that most tend to look at, if they look at any of them, it is the profit and loss statement. It's also sometimes called the income statement or the profit and loss, or P&L rather, abbreviation for profit and loss, but they're all the same thing. If somebody says, I have your income statement, they mean profit and loss, or they say profit and loss, it's the income statement. Those are all interchangeable words for the same report. It shows totals for a period of time, and that could be a month, a quarter, a year, it could be a week, it could be multiple years. It shows the sum of results over whatever that time period is. So if you're looking at the profit and loss for a month, it's going to show you the sum of activity across those 30 days or 31 days, whatever it is. And it's one of, again, the main reports a business owner looks at to see how the business is doing. Because what it's telling you is whether or not your business is generating a profit, which is the income is more than the expenses, or a loss, where the income is less than the expenses. So profit and loss, sometimes people even get confused. Does it show me both? Does it show me, is it a profit statement or a loss statement, or how does that? It is a profit and loss statement, which if you stop and think about it, doesn't make a ton of sense because you generally have one or the other. You don't have both at the same time, but that's what it is reporting, is whether or not the income was more than or less than the expenses for whatever time period you're looking at. If the income was more than the expenses, you have a profit. If the income was less than the expenses, then you have a loss. More money went out of the business than came into the business for that period of time. One thing it doesn't tell you about is your cash flow or your cash position. You can have a profitable business on your profit and loss statement that still had more money go out than came in, which on the face of it doesn't make a ton of sense. This is one of those ways it can get a little confusing. Not everything that leaves the business is an expense, and I'll get into what is and what isn't an expense, but not all the cash that leaves a business is an expense. So when you look at your profit and loss and you say that number at the bottom isn't what's left in the bank account, that doesn't mean the profit and loss statement is wrong. It just means everything that is an expense isn't everything that went out of the bank. By the same token, not everything that comes into the bank account is income. So your bank balance actually could be a lot higher than whatever the profit number is if you have a profit on your profit and loss, because of things that came into your bank that don't go on as income or as expenses. So the other part of that is it doesn't show you how much that you have in the bank. Sometimes we've had clients say, okay, well, this profit and loss statement can't be right because the number at the bottom is not how much I have in the bank. Well, okay, it's not meant to be how much you have in the bank. And again, for reasons I'll go through in this video, the profit and loss is not a statement of what is and isn't in the bank, or what came into the bank and what went out of the bank. It's a statement of most of what went in and most of what came out, usually, but it's not everything that came in or everything that went out. It is a statement of the business revenue minus the business expense. So that's an important distinction. And if you're looking at the profit and loss and expecting it to show you what's left in the bank, or how much total cash went out that month, or how much cash you have left, it's not going to do those things. It's still very useful and still very important, but don't set the wrong expectation for what it is going to tell you, because you don't want to be disappointed or confused when those aren't the answers that come out from that profit and loss. And that is a common misunderstanding that new business owners or business owners who've just never had any financial education don't understand. You would think on the surface of it that everything that comes into the business should go on the income statement and everything that comes out of the business should go on the income statement. But that's just not the way it works. So in simple sort of basic idea pictures, right? Here's the way it works. Income comes in, and income is sometimes referred to as revenue, sometimes referred to as sales. What it's not is if you've borrowed money, the amount you've borrowed comes into your business, but that's not income or revenue or sales. Or if you've invested money into your business, that is not income or revenue or sales. That's a loan. So you can invest in the business, or you can lend the business money, or you can generate money through selling whatever products or services the business actually is meant to sell. That last thing, the thing that you sell, the income that you generate from actually operating the business, that's the only amount of money coming into the bank that goes on the profit and loss. And then you have expenses, which go out. Expenses are things you spend in the course of operating the business that come out of the sales that you're generating from the business. Or if the business isn't generating enough sales or any sales yet, then expenses are coming out of the business bank account that you funded from some other source. You put personal savings into the business, or you borrowed money in the business, or some combination, or you're putting it on credit cards that you will then pay from the business account, whatever it is. But not all the money leaving the bank account are expenses, only the ones that are used in the course of operating the business and that the accounting field says are expenses, which again, I know gets a little complicated, but we'll get into what are expenses and, more importantly, what aren't expenses, so you can understand how this P&L is going to look for you. So you've got income coming in from selling the product or service that your business sells, expenses going out from operating the business. And then if there's something left, that's your profit. That's the profit part of profit and loss. If it turns out the red portion is bigger here than the green portion, then you have no profit. And in fact, the difference is then a loss. If your expenses are 110 and your income is only 100, then you have a minus 10, a loss of 10, because your expenses were 10 greater than your income. If you have income of 100, expenses of 80, then your profit is the remainder, the 20 that's left. So this is just visualizing what is on the income statement. Income comes in, expenses go out, and is what's left. If it's positive, expenses are less than income, you've got a profit. If expenses are greater than income, you have a loss. Now, in a very basic sense, this is a P&L, a profit and loss statement, or an income statement. You have $10,000 of income that comes in from running the business. You spend $1,500 on advertising, $500 on office supplies, $1,000 on rent. If that was all you had for expenses, then you'd have a net profit of $7,000. $10,000 minus the sum of those three expenses leaves you with $7,000 net profit. So very basic P&L. All of them are built the same way. The income section is at the top, then the expenses section is in the middle, and then the net profit section is the last line at the bottom. And that's either a positive number or a negative number for whatever time period you're looking at. Let's talk about what goes into income. Again, sometimes also called sales or revenue. Those are all basically interchangeable words for the same thing. So what goes in there is money from the sale of your primary line or lines of business. So if you're an e-commerce seller, it's the products you sell online. If you sell services like massage therapist, then it's the money you make from selling the massages. Or if you're an attorney, it's the money you make from providing legal services, etc. If you sell both services and products you sell, it's the combination of all the money that comes in from the sale of those products and services. Now, what doesn't go into income? Well, Sales tax is one good example that is not income. Why isn't it income? I'm collecting it at the time I'm selling something and I'm paying it later. Isn't that income and expense? Well, no. In the accounting world, sales tax is an extra tax that's added on to the sale of some things, usually physical products that you sell, but it's not income because you're not earning it, and it's not an expense because it's not a cost of you doing business. The way they look at it is it's a liability. You've collected it, but you owe it to the government. And then when you pay it to the government, that liability is reduced. You've cleared your debt with the government. So you collect it on behalf of the government. It's not income. It's just extra money you collect. And then you pay that back to the government. You owe it to them. So it's a liability, a debt. And then once you've paid it to them, your debt is cleared. So sales tax is not income. So if you sell something for $100 and you live where sales tax is 8%, so you collect $108 total. $100 goes on your P&L or income statement. $100 is revenue, it's income. The other $8 does not go on the P&L. It goes on the balance sheet, which is where you have a record of things you owe. So $8 goes on there as a liability, meaning you owe $8. You've collected $8, but now you owe it to the government because you collected it on their behalf. So it is not income. So money from borrowing is another thing that doesn't go on the profit and loss statement because it's not money you made from selling something. It's money you agreed to borrow and pay back at a later date. So that also goes on the balance sheet, not the income statement. Money from investing, whether it's you putting money into your own business or bringing in a partner who invests or an outside investor who invests in the business. This is not money you made from selling anything, so it doesn't go on the income statement. Even though these are all things that come into your bank account, they do not go on the income statement or P&L. Interest income. Now, this does go on the P&L, but not in the income section. And I'll get to where it goes in a while. Unless interest is your primary line of business, like you're a bank, right? Interest doesn't go in the income section. Likewise, money from things that aren't your primary line of business. If you have a truck as part of owning your business, let's say you're a plumber, you have a truck that you use for your plumbing business, and after a few years, you decide to sell that truck so you can buy a new one. Well, when you sell that truck and say you sell it for $30,000, that $30,000 doesn't go in the income section of your profit and loss. It goes in another place because selling plumbing trucks isn't your main business. It's just an ancillary part of what happened in the course of doing your plumbing business. So it doesn't go on the P&L in the income section. Now, what goes in expenses? So money you pay out to run your business, things like advertising, rent, insurance, payroll, anything that you are spending money on in the course of running your primary business. Well, it doesn't go in expenses. So the principal portion of a loan payment. Now, this is one that is hard for people to wrap their heads around because if I borrow money and I have to make payments every month of $1,000, that's an expense. It's for my business. My business is paying it. Why wouldn't the $1,000 go in the expense section of a profit and loss? I'm paying it out. It's reducing the amount of money that I get to take home. Isn't that reducing my profit? Well, in the accounting world, the answer is no. You borrow $1,000, you pay back $1,000. In the accounting world, that's considered a wash, right? You got $1,000 not from selling things, not in the course of your regular business, and you gave back $1,000. At the end of that transaction, you're exactly where you were when you started. You're not ahead 1,000, you're not behind 1,000, you're back to zero. So that's neither income or expense, right? If it's not income when you borrow the $1,000, then it doesn't make sense it would be an expense when you pay the $1,000 back. So what is the expense? The expense of borrowing money is the interest part. So the interest is the cost of borrowing. You borrow 1,000, you pay back 1,000, you're at zero, except borrowing isn't usually free. So let's say you borrow 1,000, but you've agreed you're going to pay back 1,100. So the 1,000 that you pay back, the amount you originally borrowed, is not income, it's not an expense, not on the P&L. But the extra $100 that it cost you to borrow that $1,000, that is an expense. That does go on the P&L in the expense section as an interest expense. That is the part that even after you paid all the money back, doesn't leave you at zero. So when you're looking at, did I make money or lose money? The interest expense is reducing your profit, but paying back the original money that you borrowed is just getting you back to where you were from before and not reducing your profit. Even though I 100% agree with you, it feels like an expense because it's money coming out of your pocket that you can't spend on other things. So From an accounting standpoint, only the interest is an expense. The principal portion, the repayment amount of the original borrowed amount, is not an expense. Now, next thing, owner's draw. Why doesn't owner's draw count as an expense? Because it's not an expense of the business. It's the benefit you get from owning the business. So this is just a hard concept to kind of wrap your head around as an owner, but essentially the profit that your business generates is the amount that you're able to take out of the business. But if we counted owner's draw as an expense, then essentially the business could end up with no profit or even a loss if you took more out of the business, but it would just be you taking it out. So it doesn't count as an expense because it's really the money that you've made from operating the business in the first place. The only way there's money to draw out is because the business made a profit. So if we counted owner's draw as an expense, then we'd be artificially understating the profit, which doesn't make sense in accounting. So owner's draws are recorded, but on the balance sheet as part of the equity in the business, part of the benefit of owning the business, not as an expense. Now, sales tax payments, like we kind of went over just with the idea of a loan, right? If sales tax collected is an income, then it doesn't make sense that sales tax paid out would be an expense. So when you make sales tax payments, those reduce the amount that you collected. You collect $1,000 in sales tax, you pay out $1,000 in sales tax. Now you're back at zero. You don't owe any more sales tax. As you collect more sales tax, you pay back more sales tax. That balance keeps going up and down. But if we're not counting the collection as income, then we can hardly count the payment as an expense. Otherwise, we would be double dipping, essentially. We'd be able to artificially decrease our profit without at the same time increasing our income. And you could say, well, if I want to count my sales tax as income, then can I count my sales tax as an expense? You can. You'll get the same profit as if you didn't count either income or expense from sales tax. But since you're ending up at the same place, why not do it right in the first place and not count either the sales tax as income or sales tax payments as expenses, which is the proper way to do the accounting. And then asset purchases. If you buy equipment for the business that you're not going to immediately turn around and fully use, so the definition for an asset is it has useful life of more than a year and value of $2,500 or more. So like you buy a new plumbing truck for your business, that isn't an expense because you're not using it all up right when you buy it. You might have that truck for 5 years, right? So in the accounting world, accounting rules say you can't put that $100,000 truck on your profit and loss as an expense because you're going to be using that and benefiting from it for years. So that's really an asset of your business, and therefore it goes in the asset section of a balance sheet. But what you can write off is the depreciation, the reduction in value over time of that asset as it gets used up. That is an allowable expense, but there's lots of rules around how much you can write off and how quickly, depending on what kind of asset you've purchased. But the total purchase price of something that's worth $2,500 or more and will have a useful life of at least 1 year is not an expense anymore. It now is an asset. And then I guess lastly, non-business expenses don't go in expenses. So if you're using your business to buy things for yourself personally, those don't count as business expenses because only expenses for the business count as business expenses. All right, now we've covered income, what is and isn't income. We've covered expenses, what are and aren't expenses. Now let's talk a little bit about when you look at the profit and loss statement, what are those categories? What should we name those various categories, or accounts is really what they're called. So every time money comes into the business or goes out of the business, we want to put it in one and only one account so we know what kind of income or expense it was. Ideally, your accounts should be specific to your business. So if you do auto repairs, you might want to have one account for labor and one account for parts, because those are the two primary things that your auto repair business is generating income from. And it's much more helpful to have it called that, so you can kind of see how much is labor and how profitable are the labor sales, and how much is parts bringing in and how profitable are the part sales, rather than just having everything called income, right? And you can get more detailed if it makes sense to get more detailed. You want each account to be useful, so it's something you do often enough that there's a decent volume of activity in that account, and it's different enough from all the other accounts that it doesn't become confusing about where something should go. So if you have too many accounts, sometimes trying to figure out what any particular purchase is and where it would go becomes confusing. For example, if you're that auto repair business and you have expenses for brakes, brake shoes, brake linings, brake discs, brake cables, and then you get an expense from some supplier and the expense memo just says brake parts, well, where does that go? Or do you have to sit there and figure out how to split up a $50 transaction into 4 different parts? And realistically, you want to ask yourself, is it helpful to me to have 5 different accounts all related to brakes? Maybe if you're a brake shop and you specialize in brakes and you have $1 million worth of revenue from brakes, that might be helpful. There might be some value in distinguishing the different kinds of brake work that you do. But if you're a repair shop that does all kinds of stuff, motors and oil changes and mufflers and wheels and brakes just happens to be one of them, then it probably doesn't make sense to have 5 different accounts for brake parts. Otherwise, you're going to end up with 400 accounts for all the kinds of service you do. And some of them at the end of a year may only have $50 or $100 in. So make sure they're both useful and discrete, not too broad like car repair, when really you could at least divide that into labor and parts, but also not too granular. I've seen people use things like Christmas party decorations as an account, or even 2023 Christmas party decorations. An account you may only use 1 or 2 times in the entire life of the business. That is not useful. Now, avoid a category like miscellaneous or uncategorized because it's too easy to just throw all kinds of stuff in there that you know should go somewhere, but you don't have time or don't want to take the time to figure it out, because what happens over time is pretty soon that category gets so big and so random that it doesn't tell you anything at all and is no longer helpful. You also want to avoid accounts named to a specific vendor or a specific employee, because vendors come and go and employees come and go, and it doesn't make sense to have something called Bob's credit card or Bob's auto expense or Goodyear tire expense, because at some point you may stop using Goodyear or Bob may not work there anymore. And now those accounts become inactive, but they used to have information in them. So you'd want to have an account called Tire Vendor, and then whether you're using Goodyear or Midas or Dunlop, they all go to the same place. Or whether it's Bob or Susie or Jim, those travel expenses all go in the same category. And you definitely want to avoid dates or one-time events like 2023 Christmas party decorations, something you will literally only use once or a few times for the year and never ever use again. So if you are a Christmas party decorations big spender, or that somehow relates to your business, then at least don't put the year in there. All right. Now, the next kind of profit and loss that's a little more complicated than the one we showed before is one that has a cost of goods sold section. Now, cost of goods sold goes between the income and the expense section. And cost of goods sold is really just a specialized kind of expense. What cost of goods sold is expenses that are directly attributable to individual product sales or service sales. In other words, if you had one particular product that you sold, you can say the expense for this product, I can get down to the single unit level, or the expense for this service, I can directly attribute the cost of selling this one service to some particular expenses. And I want to track that separately from generic expenses like advertising that goes across many sales, office supplies that is not particular to one sale, or rent, which I run my whole business out of my location. It's not attributable to one specific sale. So cost of goods sold is a specific kind of expense. So what are COGS exactly? Again, COGS is cost of goods sold, where the cost is directly related to the item being sold. It could be materials, it could be the specific inventory units or the packaging, freight related to that specific sale, where you could say, if I sold one more of this unit, it would add this much more to my cost of goods sold. Or if I sold one less, it would take this amount off my cost of goods sold. Whereas again, rent is going to be the same every month, whether you sell more or less of the same product. Advertising spend is separate from how many sales you make of a particular product. Packaging and shipping again goes with it. Labor, if there is specific labor that goes into a product or service that you can delineate specifically, one sale equals this much of this labor. Another part that goes into cost of goods sold is payment processing costs. So if you accept credit cards for payment, you sell one unit that costs $100. and then somebody pays you for that with a credit card, you have a merchant processing account. It's usually 2 or 3%. So instead of you getting $100, you're going to get $97 or $98. But the amount that you pay to the merchant is dependent on you having made that sale. If you didn't make that sale, they wouldn't have charged you the $2 or $3. Every time you make that sale, they charge you that amount. So it is a directly attributable cost that varies depending on how many things you sell. So merchant account fees are very often found in the cost of goods sold section in a profit and loss statement, and that's why. And then anything else related to the sales fulfillment costs of getting those individual units or individual services sold to your customers are cost of goods sold. Now, the next section that can be added to the profit and loss is other income and other expenses. So when I had said earlier that, for example, interest income doesn't go in the income section of your profit and loss, it doesn't mean that it doesn't go anywhere on there. It just means it doesn't go at the top. So now the order of a profit and loss statement is income, cost of goods sold, if it applies to the business, expenses, and then other income, other expenses, if the business has either of those, and then finally the bottom line, net profit. After the regular income, regular expenses, which includes cost of goods sold, there can be a line for net operating income, which is the business income that results from operating the business in its normal fashion. And then other income and other expenses are things that aren't related to the regular business operations. Like we talked about before, it could be interest income, it could be income from selling a vehicle, and other expenses are those things that the business may spend as a result of something that happened in the business, but not in the normal course of business. So what is other income? Again, income not from a regular business activity. Things like interest income, selling an asset, if you got an insurance payout, or back when, most people are done with them now, but back when the government was giving out PPP loans or ERC loans that they were then forgiving, that was other income. Or if aside from the normal course of business, you have a rental property, you get rental property income, that would be other income. Or if you have an investment, it pays dividends, or you sell it and make money from that investment, but that's not your main line of business, that would go into other income. Other expense are sometimes one-time expenses that aren't part of your normal business, expenses unrelated to the regular business, amortization and depreciation. Like I was saying earlier, if you bought a truck for the business, you don't get to put an expense in then, but if it depreciates, then you get to use that depreciation amount. The reduction in value becomes an expense, and other expense that reduces your profit, but that's not part of your normal business. That's sort of a bonus expense for tax purposes that you get to reduce your income by. So that amortization or depreciation, which is the write down of goodwill, which I know I'm getting a little in the weeds on the accounting. Most businesses don't have amortization, not something you have to worry about most of the time, but it works like depreciation, but for intangible items, trademarks and goodwill and patents and things like that. But you get to take the expense, but not all up front. Over time, those are other expenses. Discretionary expenses might go into other expenses, things that you choose to spend on the business, but that not everybody would choose to spend that way. Things like travel, continuing education, meals and entertainment, things. So other income minus other expenses equals total other income, even if it's negative. So sometimes this is confusing, and this is a QuickBooks quirk, but these two categories, other income and other expenses, both add to if it's other income and then reduce if it's other expenses your profit. But the sum of other income and other expenses is called total other income. If you happen to have more other expenses than other income, your total other income line might be a negative. And sometimes people get confused. How can my other income be negative? How can I have a loss on other income? Well, because really what they should call this line is total of other income and other expenses, but that would be really long and make the P&L even more confusing. So they just call it total other income, but just recognize that if your other expenses are greater than your other income, your total other income could be a negative number. Now, here's where it starts to really get helpful. And if you've stuck with me this far and understood how to read your P&L, then here's where the tools really start to be helpful in actually running your business and seeing how it's doing. And the first thing you can do with this is doing a P&L plus a percent of income. So what this is telling you is not only here's a bunch of numbers, but for this time period, how much did each of these income categories and expense categories actually contribute or take from the business, and where does that leave me? So in this case, we have one line for income, which is 100%. $10,000. Then we say our cost of goods sold was 40%. So out of the $10,000 we brought in, 40% of it went just right back out the door to delivering the actual products and services that people were buying from us. So another way to think of that is we have a markup from it costs us to buy something to what we're selling it for. So we buy it for $4, or costs us $4 to produce, we're selling it for $10. So we have a pretty good markup, a gross profit of 60%. But then we have other expenses, advertising, office supplies, rent, and those other expenses are 30% of our total income, right? Then we have some other income, other expenses. Our total other income in this case is negative amount. And then our net profit, everything left over after all the income, after all the expenses are subtracted from the income, our net profit is 26%. Our normal business income, our net operating income is 30%, and there's some other additions and subtractions, leaving us with a bottom line of 26% of the total income. So that in itself tells you something. It tells you that for every $100 that you bring in, you're going to keep about $25.50, which is good. It tells you that you're profitable. And in general, you can think of it as for every $4 you bring in, you're keeping one, or for every $100 you bring in, you're keeping 25 or 26. So that's generally a good business. Where this really gets helpful though is comparing it over time. If you say, okay, I want to grow my sales, but I want to keep my cost of goods sold at or below 40%. So I have a 60% or greater gross profit. And then I know if I keep my other expenses in line, I will generate around 26% net profit. That is a great way to keep an eye on how the business is doing. And if something is going up or down unexpectedly, now you know exactly where to look to fix it, or at least to find out why that's happening. So a P&L by month tells you, okay, income in July was $10,000. In August, it went up by $2,000 up to $12,000. But then in September, for some reason, it went down to $9,000. And my cost of goods sold went up when my sales went up. And then it came down from my high in August, but not down as much as in July. Advertising went up and down a bit. In fact, it went down even though sales were up, but then it went up when sales were down. That's weird. Office supplies seems like it's going up probably more than it should, and at least rent is staying steady. So net operating income went up again when sales went up, but then really came down when sales went down more than it probably should have. And overall, I had a profit in July. I had an even better profit in August, but then in September, I lost money. So by looking at this results, apples to apples, month to month, you can start to see how the business is performing and which parts you need to pay more attention to. So in this business, I would definitely look at cost of goods sold, trying to understand why, if it was 40% in July and a little bit similar in August, why all of a sudden in September it was 50%, right? Half of 9,000 is 4,500. So my cost of goods sold went from 40% in July to 50% in September. Right there, I know that's going to be a problem for me to be able to be at the same profit level if my cost of goods sold isn't holding steady. Likewise, my advertising spend went up quite a bit in September, and also for some reason office supplies. And then I had an other expense in September of $1,300, which was more than double any other month. So all in all, my September was pretty rough from a profit and loss standpoint. And if I want to fix that and continue to improve and make sure I'm profitable, then I know those are the numbers I need to watch. Even easier way to see this is to look at your columns over time with a percent of income. Now I can see, instead of having to do the math in my head, I can see cost of goods sold did a little jump from July to August, but a big jump from July to September. Likewise, advertising doubled from August and was up substantially even from July. Office supplies almost doubled, so none of those things are particularly good. Rent as a percent of income, even though the rent stayed the same number, which is correct, as a percent of income, it goes up and down a bit because it stays fixed and income changes. So that's okay. I expect the rent to stay flat. Net operating income is 30% in July. I was happy with that. August, even better, 35%. But my gosh, in September, it's down to 10%. That is not good, especially when I'm going to have whatever that big other expense was in September that hit. So P&L by month plus percent of income really tells you exactly where to zero in on this business. And if I was looking at it, if this was my business and I was looking at it, the first thing I would look at is why cost of goods sold jumped so much. I would expect it to be well under $4,000 in September, and instead it was 4,500. That swing is going to, if I could fix it, would immediately bring me from losing money that month to being positive. Then I would look at why ad spend jumped up so much, and I would look at what that other expense was that hit in September. Now, maybe that was perfectly legitimate and that happened, and that's okay, but at least I want to know. I want to make sure that I understand what that was. It was a one-time thing, and I can get back to being profitable. So now that you understand kind of what a P&L is, what goes into each category, and how to look at it, now you're at the point with this where you can see, okay, I understand what I'm looking at. I understand what it's telling me and how to have it tell me where I need to look to both set targets and then make sure I'm hitting those targets so I'm consistently growing in a profitable way. Now, one last thing to go over here on profit and loss, and that is cash basis versus accrual basis. And again, I know we're getting a little bit into the weeds on accounting terminology and concepts, but it is really pretty straightforward, but super important to understand the difference. For some businesses, all you'll ever need is cash basis, but for other businesses, you will have both cash basis and accrual basis financials and income statement, and it's important to understand what's what. Cash basis is basically like tracking the money that came in and went out of your bank account minus those things that we've already talked about that aren't included in your bank activity, or that are in your bank activity that aren't included on the profit and loss. This is a perfect way to keep track of things for a business that collects the money at the time of purchase. So if you run a restaurant, somebody comes in, they buy a meal from you, they pay for the meal at that time, they pay $30, the meal costs you $10 in food and $8 in labor, etc. Everything happens at the same time. That's great. Cash basis is really all you need. But it doesn't account for timing differences in sales and collection from when they're occurring. So if you sell something today, but the customer doesn't really pay you today, they're going to pay you later, or you sell something today that you bought 2 months ago, right? They pay you today, but you actually bought the thing they're buying from you 2 months ago. Now there's going to be a misalignment between the money you collect and the cost of delivering that thing. So in the restaurant, they buy the ham and egg breakfast from me today. I bought the ham and eggs within a few days. I paid the waiter that worked, that served today. Their hours are getting recorded today. Everything happens in about real time. There's no big delay between when I get paid for something and when I pay for something. That's the difference between cash and accrual. If you're using invoicing or you're buying inventory that you're selling later, cash basis is not going to give you an accurate picture. Accrual basis is then what you want to use, at least to understand your profitability, because what it's doing is it's matching up when you get paid for something with what that thing costs you, even if in the real world, those things happen at different times. So it records the income when the invoice is issued, even though you haven't gotten paid yet, and it records the expense when the sale was made, even if you may have already paid for that thing, or you may not pay for that thing for another month or even 3 months, 6 months, whenever it is. It doesn't relate to when the money was collected or paid out. It relates to when that sale happened and matching up the sale and the expenses so you can see the profit that happens at that point, not trying to understand the timing differences on a cash basis P&L, even though you're operating on an accrual basis, or your business runs as if it was on accrual, but you're tracking it on cash. Accrual basis doesn't let you see how you're doing with cash. So you can have a lot of invoices that looks like you're making good money. If your customers aren't paying those invoices though, you may be in trouble from a cash standpoint. So accrual basis on its own isn't a complete solution. You still also want to look at your cash, but by just looking at cash, you can't always tell if you're profitable or not. So if your sales timing doesn't line up, you want to use accrual books, but still look at cash basis as well. If you're a cash basis business, in a lot of ways, life is simpler because you only have to look at cash basis reports to understand how the business is doing, for the most part. So here's what's crazy about this, and this is the last and most complicated slide, so stick with me because we're almost done. But understanding cash basis versus accrual is summed up in this slide. This is the same business. This is exactly the same business, just recorded 2 different ways. July, August, September, same sales on a cash basis. They had actually $0 come in July, but they spent $5,000 in anticipation of providing goods and services for their customer. They didn't spend any money on advertising, although they signed up for it. They did spend money on office supplies and rent. So in the month of July, because they had no actual income come in, but they spent on a bunch of things, they had a loss of $6,500 plus some other odds and ends, other income, other expenses. Then in August, they finally had some money come in, but because they signed up some more big jobs, they had even more going out, and the advertising that they signed up for in July, the bill came due and they paid it for the first month in August. So again, at the end of August, they had another loss. And in combination, if you were looking at July and August together, they're almost $13,000 in the hole as far as profitability goes. And then finally, in September, they got paid for some of those jobs from July and August. And because they'd already bought the materials that they were going to use in those jobs, they didn't have any outlay for more materials. They did have to pay the second month of that advertising they signed up for. But at the end of it, they had an $18,000 operating profit and almost $18,000 worth of net profit. So July was a loss, August was a loss, and then in September, they had a huge profit. So if you're looking at this business just on a cash basis, the first 2 months, you might think, oh man, I don't even know if we should be in this business. We're losing money hand over fist. I hope we have enough in the bank to cover this. And if you just look at September, you'd say, oh my gosh, this is the most profitable business ever. We had $22,000 in income and almost $18,000 in profit. This is fantastic. Why can't every month be like this? So that's the cash basis story of this business. And it is accurate and it is correct. And that is what happened on a cash basis. But because the timing of how their business works doesn't line up between income and expenses, it doesn't give you a very good idea of how the business is actually doing. So now if we look at the accrual side, we can see more realistically what happened with this business. In July, they sold $12,500 worth of goods or services, whichever it is, or combination. They just didn't collect any of that, but they sold it. And as a result of knowing they'd sold it, they bought $5,000 worth of product to service that $12,500 sale. And then they signed up for an advertising program, which they knew was going to be $3,000 a month. So they recorded that expense, even though they hadn't paid it yet. And bottom line, they had a $3,000 net operating income and almost $3,000 in profit after a few other income and other expense accounts. Then in August, they had another good month, $15,000 in additional sales, for which they bought more supplies and again paid that advertising program that second month. And they had a profit again, not as good of a profit as the first month, but they had a profit for August. And then in September, unfortunately, they had only one small sale, for which they bought some materials. That advertising program had run its course, even though the ads were still running and they still had one more bill to pay in September. They had recorded the expense in July and August when that program was running. So they didn't have any expense on their books for advertising, still had the others. And so their net operating income was actually zero. The income was offset exactly by their expenses, and they had a small $50 loss. So if you look at the cash basis, almost $18,000 in profit, offset by about $15,000 in expenses, or $14,000 in expenses. And on the accrual side, they have about $4,000 or $3,500 in profit against about the same amount in sales. But it's just a matter of timing of when they're recording the sales, when they're recording the expenses that go with the sales. So you would look at the business on an accrual basis and say it's mildly profitable, although they had a slow month in September. If you look at it on a cash basis, you'd say it's hugely unprofitable 2 months out of 3, but then in September, they had a killer month. So again, same business, same results, or same real world activity, but the results on the financials are pretty different, whether you use cash or accrual. And it's important for you to know what you're looking at and what kind of business you have. So, and at the bottom of any income statement or profit and loss statement that you ever look at, it should note whether or not it's accrual basis or cash basis. If it doesn't say, you would assume it's cash basis, but it should say at the bottom whether it's accrual or cash. And for sure, if it's accrual, it should say accrual basis. So you understand what you're looking at and how this works. So hopefully that was a good explanation of how an income statement, profit and loss statement works from an accounting standpoint, but for a non-accounting person, and to understand that your bank balance in your business or looking at your bank statement for what's coming and going is a start. It's better than looking at nothing. But improvement and being able to really operate your business as a smart business owner comes from getting into the details. What income came in, what expenses went out, and more importantly, how do I look at them in the context of month over month and as a percent of income? And then based on these results, what goals can I set and what do I need to monitor to make sure the business is really performing as well as I want it to? It's not slowly going down or out of business or building up debt or running into a cash deficit, and I'm going to be surprised by that or not understand why that's happening. With just a little bit of work looking at your profit and loss each month, you can immediately see exactly how your business is doing, understand where it's performing well, understand where it's underperforming, and then knowing where you need to go in and make corrections or set new goals and increase the business and continually improve its performance. Improving the performance a little bit every month is really the key to being able to grow a large, successful business. It doesn't happen overnight. And in a lot of ways, having huge month over month, year over year growth is almost as hard to deal with as having little or no growth, right? Tremendous growth brings its own problems. The ideal situation is a moderate amount of growth that keeps happening over and over and over again, improving on performance. And that is very much in your control and very much doable as long as you've set your sights on exactly what's happening and you work on those incremental improvements. So if you have more questions, feedback, you need help on this, you're not still understanding the numbers, or you want to deep dive into your own numbers or how you can improve them, make them better, understand them better, get more out of them, let us know. We can help. Here's our info, and keep an eye out for the balance sheet companion video to this one, because the balance sheet is the other key report that goes with your business, that comes out of your financial reports, that really can help you understand exactly where your business is at.